You think the bank lends out the money that savers put in. It doesn't. The moment a bank approves your loan, it types new money into a screen, money that did not exist 1 second earlier, backed by nothing but your signature. It isn't breaking a single law. It's the biggest legal counterfeiting operation on Earth, and it runs every hour of every day. And once you see how the trick works, you'll understand exactly why the average person runs faster and faster and somehow never quite gets ahead. Here is the story you were taught. Savers walk into a bank and hand over their spare cash. The bank keeps a little of it in the drawer and lends the rest to someone who needs a loan. The bank is just a middleman, a careful little warehouse that moves other people's money from the people who have it to the people who want it. It's a comforting picture. It's also almost completely wrong. Think of it less like a warehouse and more like a family business that discovered a private printing press. The kind of press that only they are allowed to run. They don't move your money from one drawer to another. They create fresh money the instant you sign, and they charge you interest on money that was never there to begin with. Hold that idea, because there is one word that unlocks the entire scheme, and you'll get it before the end. The word is reserves. But to really see the trick, you have to go back about 400 years, to the men who invented it by accident. Picture London in the 1600s. There are no banks the way you know them. There are goldsmiths, craftsmen who work with gold, and because they work with gold, they own the strongest safes in the city. So ordinary people start paying the goldsmith a small fee to guard their coins. In return, the goldsmith writes you a paper receipt. This receipt says the bearer can collect a certain amount of gold on demand. The historian Glenn Davies, in his sweeping book, A History of Money, traces exactly this moment, the rise of the goldsmith banker, as the point where paper money quietly began to overtake actual coins. Now watch what happens next, because this is where a locksmith turns into a counterfeiter. The goldsmiths notice something. On any given day, only a handful of people actually come in to collect their gold. Most of the receipts just circulate from hand to hand, as if the paper itself were money. The gold mostly sits in the vault, untouched, gathering dust. So the goldsmith has a quiet, dangerous thought. If the gold just sits there, why not write out a few extra receipts? Receipts for gold that nobody actually deposited. Lend those paper receipts to a merchant, charge him interest, and as long as everyone doesn't show up at once demanding real gold, no one will ever know the difference. And just like that, money was created out of nothing. Paper claims on gold that did not exist. This is the origin of what economists call fractional reserve banking, and the phrase sounds intimidating, so let's strip it down. Reserve just means the real cash actually sitting in the vault. Fractional just means the vault only ever holds a small fraction of what the bank has promised to pay out. The goldsmith owed 100 coins on paper, but held maybe 10 real ones. He was betting, correctly, that the other 90 would never be asked for on the same day. Now think about how quietly powerful that little bet is. The goldsmith wasn't just earning a storage fee anymore. He was earning interest on gold that was never his, that in fact was never anyone's, because it did not exist. He got rich on the gap between what he promised and what he held, and the wider he stretched that gap, the richer he got. There was only one way the scheme could ever break. If too many people showed up on the same morning demanding their real coins, the vault would run dry, the paper would be exposed as a bluff, and the goldsmith would be finished. That single fear, the crowd at the door, is the same fear that has haunted every bank ever since. There is even a name for it now, a bank run. It worked anyway. It made the goldsmith spectacularly rich, and it never stopped. It just got a bigger, cleaner, more respectable building. So that's the old racket. Here's where it gets worse, because the modern version doesn't even bother with the gold. For decades, most people, including plenty of bankers, believed a softer version of the story. They thought the bank takes in your deposit first, keeps a slice, and then lends the rest out. Money in, then money out. The order matters, so remember it. Deposit first, loan second. That is the version taught in classrooms for the better part of a century. And in 2014, the Bank of England, the central bank of the United Kingdom, one of the oldest and most conservative financial institutions on the planet, published a paper that quietly set that story on fire. The paper is called Money Creation in the Modern Economy, written by 3 of their own economists, Michael McLeay, Amar Radia, and Ryland Thomas. And in plain, official language, they admitted the order is backwards. Banks do not wait for your deposit and then lend it out. When a bank makes a loan, it creates a brand new deposit at the very same moment. The loan comes first. The money is conjured into your account by the act of lending itself. In their own words, the act of making the loan creates the deposit. The middleman story you were taught, they wrote, is simply not how it works. Sit with that for a second, because it's genuinely strange. When you take out a $30,000 car loan, the bank does not go find $30,000 that some careful saver set aside. It opens your account and types the number 30,000 into it. That number is new money. It is now spendable. It now exists in the economy, and 1 second earlier it did not. The bank didn't move money. It manufactured it on the spot and attached your name and your interest payments to it. Now, you might reasonably ask, is that just clever accounting, or is it really new money out of thin air? Because that is exactly the kind of claim that sounds too wild to be true. And for a long time, nobody had actually tested it. Everyone argued theory. Nobody ran the experiment. Until an economist named Richard Werner decided to do something almost nobody in banking history had ever done. He ran the test in the real world. In 2014, Werner published a study with a title that sounds like a dare: Can banks individually create money out of nothing? And to answer it, he didn't sit at a desk. He worked with a real, cooperating bank, borrowed real money, and got permission to watch the bank's own internal books as the loan was processed. He wanted to see, with his own eyes, whether the bank moved the money out of some other account, someone else's savings, someone else's reserves, or whether it simply created it. The answer was clean and a little chilling. The bank took the money from no one. No other account went down. The funds were newly invented on the spot, the first time in banking history anyone had empirically proven it. The Goldsmiths trick, confirmed under laboratory conditions, for centuries later. So here's the counterintuitive twist, the part that flips your whole picture of who's really in charge. If banks create money whenever they make loans, then banks, not the government, create the vast majority of the money in your economy. Most people assume money is printed by the state, in some guarded building, under lock and key. But physical cash, the notes and coins, is a tiny sliver of the total. The overwhelming majority of the money in circulation isn't printed at all. It's typed into existence by private banks every time they say yes to a loan. The family business isn't renting space in the economy. It's quietly issuing the economy's money. Which finally brings us back to that one word: reserves. If a bank can just invent money, what stops it from inventing an infinite amount and buying the entire world? The honest answer is less reassuring than you'd hope. Reserves are the special money that banks keep at the central bank to settle up with each other at the end of the day, the real cash in the modern vault. And the limit on a bank isn't some pile of gold. The limit is whether lending stays profitable, whether borrowers pay it back, and whether the regulators are watching. The brakes are real, but they are soft, and they are held by the same family that runs the press. Now hold this trick up against your own life, because this is where it stops being history and starts being your paycheck. You earn money the slow way. You trade your hours, your energy, your one and only life for a number in an account. Every dollar you have cost you time you will never get back. But the money you're competing against, the money bidding up the price of houses, of stocks, of the assets that actually make people wealthy, a huge share of that money was typed into existence at near zero cost by someone who simply had the license to type it. That is the quiet, grinding unfairness of it. You race to earn money by the hour. They create it by the keystroke. And then they lend it back to you, with interest, and call it a mortgage. That's not a conspiracy whispered in a back room. It's printed in a Bank of England bulletin you can read tonight. The heist isn't hidden. It's just boring enough and technical enough that almost no one bothers to look. And the people who profit from it are counting on exactly that. If reading that made the ground shift a little under your feet, good. That feeling is you waking up to how the machine actually works, and that instinct, to look past the comforting story and follow the money to where it's really made, is the single most valuable habit a person building wealth can have. So subscribe and stay here, because that is exactly what this channel does, week after week. It decodes the games the financial world would rather you never understood. Next time, the question gets sharper and closer to home. If new money keeps getting typed into existence, where does it all end up, and why does more of it flooding in almost always make your dollar buy less? That's the other half of the trick, the half that quietly picks your pocket while you sleep, and it's the very next story. Because here's the thing to remember every time someone tells you the bank is just a careful little warehouse for savers' money. It isn't. The moment you sign, it types new money into a screen out of thin air and quietly makes you pay it back for the privilege.